All right, everybody, welcome back. So in this video, we're going to cover something really basic. It's really important to trading options. I see this all the time in the chat, and I think that people just are kind of missing the point. So I'm going to help you see the point. Why it's important to trade something like SPY until you get familiar with it when you're trying to day trade in the options world. Let me just go ahead and get this trade on. I've been waiting to get. And we'll get started. All right, so it all comes down to liquidity and how liquidity connects to the bid-ask spread. All right, so we're going to go over to SPY. And what I want you to notice here in SPY is the difference between the bid and the ask. All right, let's get the drawing tools over here. So the difference in the bid and the ask on SPY is around 1 or 2 pennies. And the problem with getting filled, like me not getting filled in that SPX trade that I just attempted to get into, is when we're trying to hit the mid. I'm just going to cancel that. I didn't get filled. When we're trying to get into a trade, we want to try to get a trade around the midpoint, right? So here on the SPX, we're looking at, the bid is 450, the ask is 460. If we can get in at the mid, then we can get in around 425. Perfect, right there, right in the middle, right? It was 425 when this was at 420 and that was at 430. Now we're talking about a difference of $10 total, but if you can get the mid, maybe you cut $5 out of that. Why is it important? Well, this is not too bad. This is only $5. But if we go into a market, say like Google, 23.90, 25.30, you're getting filled at 24.65 if you get the mid. 24.65. We'll just round down and say 24.60. That's a $60 slip. Okay, so if you just hit the buy button and you try to buy this at 25.40, one of the institutions like Susquehanna, they're going to sell it to you. You're the buyer, you want in, you hit buy, you pay $25.50, they sell it to you. And then they immediately reach right back out into the market and they sell a position somewhere else. So they buy it back so that they're flat. They sold to you. So they sold to open, you bought to open, and then they came right back in and got rid of it. Okay, they got rid of all of their risk. They made money on you. They made $60 in the blink of an eye, poof, just like that. While you are still sitting there carrying all of your risk. And oh, by the way, as soon as you got filled, you're now in the hole, $60. Your trade is automatically already losing, and the trade hasn't even gone anywhere yet. So you're trying to get filled and you're already in the hole just because you hit the ask right on the dot right now just to get in because you wanted in and you didn't want to get left behind. And I get that. We want our trade, right? You know how it is. Come out and look at a chart. So here's today's market. Say we're looking at Google and we want to trade it when price gets to the top of the range, 29.07, and we're going to trade a breakout, right? Just some random thing. So we're watching price. It comes up to the top. It's getting ready to break out. We don't want to be left behind. So we run in there and we hit the button and it says 28.20. But the mid is 27.50. As soon as you get filled, you're now in the hole, $80, just like that. Poof, in the blink of an eye. Your trade first has to make up all of that, and then you start making your way out of the hole because you spent all that money. Okay. So why trade SPY? Well, if you're really new to options, and heck, even if you're just new to trading, the bid ask in here is very, very small. So let's go 4 days out. That would be Friday. And look at Friday's values in here. Okay, there's the bid, there's the ask, and here's the mid. And we're just going to focus on an at the money call in SPY for Friday's expiration. Now you can market order into this without even trying to split the difference, because right now there is just 1 penny difference. You're slipping a penny, right? You can give away $1, sure. You just hit market order and you're in it and no problem, right? You don't have to worry about how much you're slipping. We never want to give away money, right? We want to try to get the midpoint, but there are times when we're really in a hurry and we want this thing filled and we just don't want to miss our trade, right? Price is finally doing what we've been waiting for it to do. It's making that move. We want to get in. If you try to negotiate for the mid price, you're very likely going to miss the trade. In SPY, you never have to negotiate for that mid price. It's almost always a penny away. You know, it's a very minute amount of slippage. You jump in, you got it. Bob's your uncle. This would give you a chance to learn the ins and outs of day trading options without severely handicapping your position. Because I'm telling you right now, if you randomly go out and you just pick something to day trade, there's a $10 slippage right there. Half of that is $5. So you're down $5 just to get into the trade. And I know it's only $5, right? Not a big deal, except you're already in the hole, $380 anyways. So before you can even start making profit, you've got to get that covered. You spent $380. Now, granted, you know, if you buy it for $382 and then you sell it for $392, you made $10 profit. You didn't have to recap the entire $385 and then start making profit, but you're in the hole. You have money on the line, and trying to get the mid in something like Facebook is going to save you $5. But I don't just trade Facebook, right? We trade a lot of things. And I'm a real big fan of trading in the SPX. Now, here's the problem between SPY and SPX. Even though this is considered the mother of all products, it is, you know, one of the most historic and venerated things that you could ever trade. It is super, super liquid. That is a wide bid-ask spread. It's $15 slippage at the money, right? $15. Out here, it's not too bad, $10 if you can time it right. It's a little bit laggy. Now, why is it connected to liquidity? Well, the more liquid it is, the more traders are participating, the more they are fighting for a more fair price. And you're lucky, you're often going to see a lower bid-ask spread difference. So the more traders there are, typically the tighter the spread, the less you slip. When you get into things that aren't so liquid, then the spread becomes a lot wider and you're finding it harder to get filled, even if you are willing to pay the asking price, which you shouldn't be wanting to do, right? So here's Caterpillar. That's a pretty popular name. $10 spread, $5 of slippage. It's not that bad, but look, we're only going 4 days out, you know, and in a day trade, I mean, that's what a lot of us do. How about we go 11 days out? What's the slippage look like? What if we went back to Facebook or we went to Google? right? So I get it. You want filled. You're in a hurry. You are willing to pay to get in, but you really have to think about how much am I slipping? And when I see people say, oh, well, I added another 2 or 3 weeks because I wanted to give myself time, and then they're getting out in the same day, what are you giving yourself time for? If you honestly think you really are going to get out at the end of the day, you don't need a month. There's no benefit to you to go all the way out to January 21, 18 days to expiration, when you know in your heart of hearts that you're getting out of this thing in an hour or less. If you wanted to give yourself a little bit of time, you could go 1 extra week out. Anything more than that, you're just handicapping your position with bid-ask spread differential, especially if you're just buying it on the ask. But you're also handicapping yourself by time, right? Because the more time that's in that thing, the more money is in it. It's going to cost you more money to go that far out, and you're not getting any benefit. A lot of times those farther out options won't even make as much money in the move. So then your underlying market makes a $6 move, and you see maybe 20 cents on the dollar. For every $1 it moves, you make 20 cents if you go far out. Whereas if you were closing in, maybe, you made 45 cents on the dollar. So when you're getting ready to take a trade, look at how liquid it is. Look at the volume today, 9 on the volume, 9. And Google's supposed to be, popular. Everybody wants to trade Google. Open interest, 18. So 18 people are holding options in this. And today it's had 22 trades. Now in the morning, we'll know if these were day trades or not, because 18 will go up or go down. But that's not a lot of liquidity. And look at the bid-ask spread, right? That is $70 of slippage, $80 of slippage, excuse me. So you're slipping $80 here. As soon as you're filled, you're down $80. And then you've got to work to see the trade rally out past that just before you're out of the hole. So start with something like SPY. It has 1 penny wide differences. And even if you go out a few days, it's still a very liquid product. This way, you can just come right in and hit the ask and pay whatever they're asking for it. And you're really not slipping that much. You're almost guaranteed to get filled because it's super liquid. Look at how much volume today, 19,600 contracts traded today. You can get in and out really fast, very tight slippage. This is the perfect day trade product to learn how to trade options without getting severely handicapped. I appreciate your time, guys. I look forward to seeing you at the next video.